Since the recovery started, all eyes have been focused with wonder on the US stock market, with American indices like the S&P 500 powering ahead of its counterparts in the UK and other regions around the world. The S&P 500, America's main stock index, has risen by around 35% in the 3 months since the markets crashed in March, while the FTSE 100 has only risen by around 21%.
And it's not just a 2020 phenomenon. America smashed all other stock market regions for the past decade, reaching back to the end of the 2009 financial crisis. The S&P 500 has consistently outperformed the FTSE 100, the UK's main index, on growth, and has been on the face of it the superior place to store and grow your wealth.
So what is going on in America? Why is the S&P 500 smashing the FTSE, and should US stocks be making up a larger chunk of your portfolio? Let's check it out.
Welcome to moneyandchaco.com, the investment and finance channel and website that's set for you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. We want to give a shout out to Stake, who are sponsoring this video. Stake is an awesome new FCA regulated investment app specializing in US stocks. It has over 3,500 US stocks and ETFs available, including all the stock market giants like Tesla, Apple, Google, Netflix and Uber, and unlimited commission-free fractional trading with trades executed in real time and FSCS protection. In short, it's a good app.
Stake will give you a free US stock worth up to $100 when you sign up via our link. We'll put the link to the offer page in the description below, so be sure to check that out. Now let's get into the video. What's in each index? The FTSE contains a large weighting of resource stocks, especially oil. We've seen the price of oil fall through the floor recently, and the FTSE has some big oil companies weighing it down. Shell and BP make up 11% of the index between them, and before oil prices fell, it was more like 17%.
In the US, on the other hand, resource stocks make up a much smaller portion of the S&P 500, which is dominated instead by tech companies. Let's have a look how they compare sector by sector. Tech makes up 36% of the S&P 500 by market cap and includes giants like Apple and Google, while tech makes up about just 3% of the FTSE 100. While America holds a future, around 20% of the FTSE 100 is made up of resource stocks, which are companies that sell commodities and materials. There is also a huge reliance on the financial sector in the UK index, and the banks have not exactly painted themselves in glory in recent years.
Diversification. The S&P 500 is much more diversified, both geographically and sector-wise, than the FTSE 100. With 500 massive US companies, there's just a lot more going on in the S&P 500, but both indexes have their weaknesses. The FTSE has too many financials, and the US has too much tech relative to other sectors. Luckily, tech is what's in demand right now, and the S&P 500 has been able to capitalise on this overweight sector.
Size. In terms of size, there is absolutely no competition. The combined market value of the S&P 500 is $28.1 trillion, while the FTSE 100 is just a little over £2 trillion. America's huge economy gives it better leverage in negotiation with other countries, which gives America's companies access to preferential treatment abroad. Look at how countries struggle to tax Google in fear of upsetting the American government.
America also has a much more stable currency. In many ways, the US dollar is the currency of the world, and super size and superior money power brings with it economies of scale. Better infrastructure, better roads, better equipped workforces, and an all-round better environment to encourage wealth creation.
What difference did quantitative easing make? Empirical evidence suggests that there is a positive correlation between QE and a rising stock market. Quantitative easing is when governments magic money from thin air and use it to buy government bonds to help get the economy moving. This increases bond prices and therefore lowers bond yields, driving investors away from bonds and towards stocks.
The UK government did £215 billion of quantitative easing in March 2020, £3,200 per person. The US, a much bigger country, did $700 billion of quantitative easing, the equivalent of £550 billion or £1,700 per person. Per head of population, the UK has blown the US out of the water in terms of quantitative easing, twice as much per person. But it hasn't translated into confidence in the UK market. Investors have been pulling out of bonds and been rushing to the stock market for safe harbour, but evidently they've been rushing to the US.
Why the S&P 500 is destroying the FTSE 100. So, there are 5 reasons why the US index is smashing the FTSE. 1. New sectors versus old sectors. America has all the tech. 2. Better diversification. 3. Ridiculous size. 4. The mighty dollar. And 5, which we will look at now, a better reputation for growth.
Yield or growth? Because the FTSE 100 has a relatively low valuation, this translates into a relatively high yield, which currently stands at around 5%. The S&P 500's yield is currently around 2%. A big reason for this is that the American technology companies, some of the S&P 500 index's largest constituents, prefer to stockpile potential dividend cash to spend instead on reinvestment and acquisitions. For example, Apple is sitting on $193 billion of cash. The FTSE therefore might offer some better buying opportunities for the higher yield, but the S&P 500 is where you'd want to have been invested for the overall returns on those high valued companies. Investors in UK stocks need higher dividends as compensation for the lower share price growth, whereas the US has been a powerhouse, more than compensating investors with incredible stock price growth regardless of the dividends.
The S&P 500 has quadrupled in price since 2009, an unprecedented bull run. The FTSE has only doubled. Even if you consider the higher dividend yield on British stocks, the performance is incomparable. Even during a coronavirus crisis, US stocks continue to soar above the pack.
Do you want higher yields in the UK but limited share price growth, or ownership of some of the best companies in the world in the US? Of course, there's nothing stopping you from investing in both, and we do. Portfolio weightings. We always say that a portfolio should be global and well diversified, not just invested in the country of your birth. As UK investors, we feel you shouldn't have any more than 20% of your portfolio in the UK stock market.
We think at least 30% of your portfolio needs to be in the US, if not more. Indeed, we'd rather be invested in only the US than in only the UK. The S&P 500 is our favourite US index, but the same points mentioned in this video can be applied to the others, such as the Nasdaq 100. The point is, America kicks ass. Question of the day: why else is the American stock market beating the UK one? Let us know your thoughts in the comments below.
Thanks for watching. On this channel we talk about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.